Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Wednesday, January 31, 2018. This is the last day of the first trading month of 2018, and basically it was for the most part a flat day. The markets were up early, they sold off during the trading session, and then rallied back in the last hour of trading to close just above the flat line. So what we can derive from that is volatility has come back to the market as we discussed that it would and should. So in terms of where the spider is, you can see here that today we came close to my $280 level on the SPY. The low today happened to be 280.68. So we haven't yet satisfied my downside target of $280. May even go slightly below that if we get a hard sell. My point here is I don't think that the selling has subsided yet from the market. I think there is one more slight leg down before this is all said and done. Not looking for a tremendous correction, not yet anyway. There will be a correction or two during 2018. However, not right now, in my opinion. I think the market is just and only working off some of this severely overbought condition that existed. So what you can see happening here on the daily chart is we're beginning to go sideways. Maybe we just get one more flush down, maybe even into the 20 period moving average, as low as that. But beyond that, I don't see much more downside than that right now. I see all this is as just working off some of the overbought condition, setting up for one more leg higher into what I believe is the month of either late February or into the month of March. That's what I think is happening. At that point in time, we should get, or would get, I believe, another corrective move in the market, and that one I think would be more severe than what we've just seen. At least that's what I think is going to take place. We'll obviously see and talk about it in real time. When you look over at the 60-minute chart or the hourly chart, you can see here that really nothing happened today. Today we hit the 100-period moving average. On the hourly chart, we bounced off that level with a pretty good rally. And then where did we finish today? Pretty much right on the line from yesterday that we traded around all day long, 281.85. Finishing the day at 281.91. Actually, I believe the official daily close today on the daily chart was 281.90. But you can see that was 5 cents above the level from yesterday, and that goes to show you the importance of that level to the market or to the SPY. So we cited that level long before price was here. The price came down to that level, and we've basically traded back and forth through that level for a couple of days. That shows you the importance of the level, but also the other reason why I wanted to bring up the hourly chart is because it's a very distinct bearish pattern the market is putting in. Generally speaking, this is going to result in another move downward, and that move should come at least to 280, potentially down to the daily chart 20 moving average as we just discussed. Here we'll take a look at the IWM, my favorite market leading indicator, and the IWM was certainly weaker than the spider or the S&P 500 all day, and that's an indication that the IWM is leading the market in the downward direction. So I think there's more downside coming in the IWM. Wouldn't be surprised to see the IWM hit the 50-period moving average on the daily chart down at 154. If it did come up short, then it would be 155. That's only a little more than $1 lower than we are now. It's really not that big of a deal. Not looking for a tremendous sell-off in any of these markets right now. Of course, today we had the Federal Reserve or FOMC interest rate announcement. They did nothing, and the market sold off after the Fed announcement. But of course, the media will blame the decline in the market in the afternoon on the Federal Reserve announcement. The reality is, as we've been talking about, the market was going down anyway. They just picked the FOMC announcement as the reason, assign it to the reason the market went down, and that becomes the reason as far as anybody is concerned. And that's very convenient, and that's the way it always works. We don't really care what the Fed said. We don't care what the media assigns the reason the market was down. Makes no difference. The market was down because the market was down. It was going down because we had been putting in a bearish pattern, and the market was going lower one way or the other. Whatever the reason they want to assign it, doesn't make any difference. Now, leading into tomorrow, we'll see what happens, but Facebook had earnings after the closing bell today, and Facebook is getting hit pretty hard after the closing bell here. So I'll just bring up a chart of Facebook, and I'll show you the aftermarket session. Let me go down to an hourly chart, and you can see where Facebook is trading in the aftermarket. And we're already down at 178, 177 and change. And what's interesting is you can see here where we actually traded right to. Keep that number in the back of your mind. See where the low is. Here, let me move this over, and I'll show you where the low is, and then you'll see right where we traded to. So the low is 177.10, and I'm going to go back to a daily chart, and you'll see here where the 100 period moving averages on the daily chart, 177.43, and that's pretty much where we traded right to and then bounced off that level, but we're hovering around that level. Any way you want to look at it, Facebook is down $9 in the aftermarket session. You can see it up here, down about 5%. So that's going to have some downward pressure posed. So we'll see what impact that has on the rest of the markets. Obviously, there's other stocks and companies that are reporting earnings after the bell, and certainly before the bell tomorrow. There's actually a lot of earnings between tonight and tomorrow morning. So that's going to be interesting to see how that shapes up leading into tomorrow's session. Of course, who knows what Facebook is going to look like by 9:30 a.m. tomorrow. Could be up, could be down more, could be right here. We have no idea. We'll see what happens early tomorrow morning. On the transports today, my second favorite leading indicator of the markets, there was really no change in the transports. They were up about $6. Not a big deal one way or the other. So we're just going to skip over the transports. Nothing new here. My take is that if the market had one more leg down in it, as little as it may be, maybe $1.50 in the spider, give or take, you'll probably see one more leg down in the transports. Doesn't have to be all that much. But in the end, the transports did their job by working off some of the overbought condition. And you can see here, we can look at the transports as having a big up move, was overbought, and now this is just a bullish pullback pattern. And even if we come down farther, it really doesn't matter, because that's setting up most likely for another leg higher in the transports, as it is in other markets as well. So there's really no damage done to the transports whatsoever. Again, just an overbought condition, eating time off the clock, working off some of that overbought condition. When we go over to the gold market, you'll see here that important 1338 level, we actually pierced it by a couple of dollars today. You can see here we came down to, I'll move this over, and we'll see where the low came in on the gold market today. Gold futures was 1335.50, and then we had a very nice rally off that level. Right now trading at 1348.20. So that's a nice rally in the gold market. And again, we talked about it last night that the markets move in and around the Fed announcement. The stock market moved after the Fed. The currencies moved. Gold moved. Oil. So basically all the markets, just as we prescribed, did move after the Fed announcement. And they always assign the reason to the Fed announcement. Why did gold go higher? Gold went higher, in my opinion, because we're finding support at the 1338 level. If you ask somebody else, especially in the media, gold moved higher based on whatever the Fed said. And frankly, I have no idea what the Fed said. I know they didn't touch interest rates, but I have no idea what they said in their quote-unquote announcement, in their rhetoric. It doesn't make any difference what they say. They normally say the same thing every time anyway. The economy is picking up, employment, this, that, and the other thing. We're worried about inflation. We're not worried about inflation. It doesn't matter what they say. They have canned statements, and the media parses their words letter by letter, word by word, and then whatever the market does, they assign the reason to whatever the Fed said. It's actually a bunch of nonsense. It's more like a kabuki theater than anything else. In my opinion, gold found support at 1338, bounced off that level, and is still essentially in a bullish position above all the moving averages. We found support at the 20-period moving average, also coinciding with the 1338 level, and this is nothing other than, as far as it is today, a bullish pullback pattern, potentially setting up for another leg higher. We'll see if that pans out. One day doesn't make a trend, but right now the trend is still up, and we still could have higher prices coming in gold. A little tough to be long from here. You wouldn't be short. I'm just a spectator as it is right now in gold. We're just analyzing the charts, and I'm giving you my opinion based on what I see on the charts. and what the chart is actually telling me. Crude oil, no surprise here. Crude oil touched the 20-period moving average overnight, had to bounce off that level. They'll assign the up day, the reason for the up day in crude oil to the Fed. Frankly, it's just a pullback into the 20-period moving average, working off some overbought condition, and now it's really free to move higher, even if it banters about down here for a couple of days. We're still in an uptrend, nothing wrong with crude oil. There's really no change to the outlook whatsoever. I think higher prices are coming in crude oil, just as we've been discussing for several days, even several weeks. Crude is grinding higher. All we did was come in to revisit home base. What's home base? Home base is the 20-period moving average. We touched it today, bounced off that level. That's a garden variety move 101. That's all it really is. We came in, checked back in at the 20, and then we bounced off that level and now potentially going higher. I do want to discuss the dollar tonight. And the dollar, we had a bottoming tail in the dollar last week. But now we're making a bearish pattern along the bottom here, and one of two things is going to happen. Obviously, one of two things is going to happen. Either we're going to go down or we're going to go up. That's obvious. I don't mean to be Captain Obvious. However, what I really want to say is anybody that's long the dollar or any vehicle that tracks the dollar can be long against the low from the other day. So the low from the 25th of January happens to be 88 and a quarter. 88.255. You can be long the dollar any daily close below 88.255, and you have to move out of the trade. But there's nothing that says this bearish pattern will or won't fail. It's just a pretty good risk-reward setup because you're very close to risk here at these lows in the dollar. But certainly we'll see what happens. I'm looking for a move higher in the dollar. I think that was a pretty good low. We could certainly go lower. I just don't think there's much lower to go in the dollar from where we are. The big earnings day is tomorrow when we have, after the closing bell, we're going to have Apple, Google, Amazon, and then you have a whole host of other companies between today and tomorrow. So there's a lot of companies reporting earnings, but the big bellwethers were Facebook, and then tomorrow you have three, Apple, Google, and Amazon. Amazon's approaching like 1,500, I think, 1,446. So we'll see what happens with Amazon. They may want to push it to 1,500 come heck or high water. We'll see what happens, but that's just an unbelievable run in Amazon. I mean, look at the monthly chart. Where is the top in this stock? I have no idea. I wouldn't even think of shorting Amazon. That's not something I'm willing to do. It's not something I'm interested in doing. This is just a monster on the upside. I'm happy to buy stuff from Amazon. I'm not going to short the stock. No way, no how. It's an absolute monster. Who knows what it'll do after earnings? I'll be a spectator, but I'm not going to trade it. It's not worth the risk, in my opinion. Certainly not holding a stock like this into earnings. So it's just too risky, at least for me. And that's about it, folks. It's everything I really wanted to and intended to discuss. All in all, there really isn't a lot of change from yesterday in the overall market, so we'll probably have some over the next day or so, but as it stands now, the markets were mainly flat on close, so I'm going to wrap it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.